All right, folks, welcome to Investing for Beginners podcast. Today, we got a fun show. Today, we have our friends Brett and Ryan from Chit Stocks to talk to us about home builders. So this is an area or a sector that probably doesn't get enough love. And these two, along with Andrew, are experts. And so I'm going to be the idiot asking the dumb questions, and they're going to show off all their knowledge. So guys, thank you for joining us again. This is your third time, I believe, with us on the show. You're starting to become regulars. So that's pretty cool. And I guess let's start talking about home builders.
Yeah, let's do it. Glad to be here, guys. And we're happy when you guys join our podcast as well. We appreciate you, Dave, filling in some of our power hours. That was a fun time a few weeks ago, and Ryan was on his big vacation in Europe. But yeah, we're excited to talk home builders and a fascinating, I think we've said this the last 3 years maybe, but it still has been. It's just a fascinating time for this industry, given where, how interest rates affect them, the supply, all the changing dynamics when people were calling for a huge bull market or bear market. And there was a lot of conflicting opinions out there. So excited to talk.
Yeah, thanks as well, Dave, for substituting in for me there and on our show. And I am appreciate the invite to this one. I'm excited to talk home builders. Brett and I have spoken about it quite a bit on our show. So we are hopefully ready with some notes and prepared with some research. So excited to dig in.
Well, I will throw the first pitch then. Hopefully it's not too much of a curveball, but somebody who's maybe not as familiar with the space might look at the interest rate situation and be like, how the heck can you look at home builders with the interest rates where they are? So what about home builders and interest rates can be maybe misinterpreted or not be as much of a red flag as someone might first think?
Yeah, well, there's no question that it impacts affordability. Obviously, it's kind of a part of the equation there, all else equal. If the average selling price of the home is still the same and rates go up, you're going to be spending more on your mortgage. However, it's always difficult to talk about the home building industry broadly because there's a lot of dynamics at work. So it's very localized. So certain geographies tend to do better than others. Certain markets of the home building industry do better. So like entry level homes versus second time move up buyers versus luxury homes, stuff like that. There's always nuance there. There are a lot of strings that home builders, especially larger home builders, can pull in terms of like kind of pushing the incentives to buy sooner. So mortgage rate buy downs is one where it can just kind of, you can maybe subsidize certain parts of the home buying process. Like you can say, oh, we'll give you this upgrade on new countertops or something included if you lock in today or whatever it is. So there's different ways for them to kind of push the demand. But on top of that, and this is a number that gets tossed around loosely, and there's always, some people have different numbers than others, but there seems to be a bit of a home shortage broadly in America. And oftentimes when rates jump, I think we saw this really throughout the last 3 years, you've got a lot of homeowners already that are locked in on low rate mortgages and they've refinanced probably over the years. And so maybe they've got 3%, 4% type mortgage rate. They don't really feel inclined to move. So it actually ends up benefiting a lot of the new builds since you don't get as much inventory unlock from the existing home builders, from the existing homeowners. So like I said, a lot of dynamics at play, but even in an environment where rates rise, there are certain home builders that can still do pretty well and demand might remain solid. And we saw that last year, actually. Some of the largest home builders closed on more homes than they did the prior year, despite mortgage rates going from 3% to I think 8% in the highest rate. Hopefully that answers a little bit of the question. Brett, if you've got anything to add, feel free to chime in.
Yeah, I think the big distinction investors need to make is that there are total home sales, but then there's two big divisions within total home sales. There's new home sales and existing home sales. And during this time, we're actually seeing, if we look at some of the data out there, existing home sales across the US. So these are homes that are not the home builders. These are existing homes that someone was living in, someone did own, and then they're exchanging it with some new person. That has fallen to a low that is basically right at the level it was during the bottom of the Great Recession in 2009, 2010. and we're at about 4 million. 4 million units annualized each year. Now, during the bubble period of the great financial crisis, which would be before, the economic recession that was in 04, 05, 06, we almost peaked at about 7 million. Now, a normalized figure, it looks like from this chart, given the last 20, 25 years, is maybe closer to 5 million, 6 million. And we're seeing the ground made up from the new home sales from these builders, because there's people stuck in these mortgages. Mortgage rates aren't going back to 3%, but there are still people that, say, for example, someone's starting a family. They just had a kid. They're 32 years old. They're looking for a place to stay. Well, they can't move in with that other couple that owns that existing home that's not selling anymore. And the gap's being made up by these home builders. And what's interesting is the new home sale data has just, if we exclude the pandemic bump where there's just an extreme amount of new home sales in, I think it was the 2020 period, we've just been up and up and up to the right after the bottom in the great financial crisis in 08, 09, 2010. And we're still nowhere near the rate of new homes built and new homes getting on the market as we were on the peak. So it doesn't, even though we've been on a long trajectory here, it doesn't seem like we're in a bubble period, although we're definitely not as supply restricted as we were, say, 8 years ago, something like that. And if we look at new homes months of supply, which is essentially the amount of new homes that are out there, I think this is the definition, amount of inventory out there of versus the rate that are sold each month, we're at about, 7.6 months, which is maybe slightly above average, but nothing too concerned about. So it seems like, to me, we'll see what happens if mortgage rates make any sort of extreme move up or down. Seems like the housing market has normalized a bit. And now if I wanted to play devil's advocate, the only really concerning thing I have for some of these home builders is the existing home sales are at such a low point. I know I'm tossing a lot of information out here to your listeners, but when I say that there's 4 million existing home sales on an annualized rate right now, well, if that jumps back up to 5.5, 6 million, well, that could take some of the demand away from the new homes, which can impact the home builders. And we'll see if that really impacts them at all, because that would kind of determine whether it's a giant housing shortage or just a small one, or if we're in if the housing market has normalized over the last 5 to 10 years.
That's a ton of great information. I'm flattered that you think I'm 32. I'm actually older than that, but you kind of described my life situation perfectly. We actually just closed on a new home last year, so it's fascinating to see it and then also live it myself. You mentioned the differences in some of these geographic differences. Anything stick out when we talk about that? Obviously, there's a lot of nuance, but was there anything either lately or in the past 3 years that's been like, wow, this is interesting?
Brett might have some better data, but I know in some of the data that I've seen, the ability to work from different places and remote work sort of as a trend has allowed, I believe, some kind of increase in citizens to some of the more affordable states. That might have been the most recent data. However, Brett, I know you follow, I can't remember what it's called, calculated risk. Do they break out anything city by city?
They do, yeah. This is the Calculated Risk newsletter. People can subscribe to it for free. They do have a premium tier, but check it out. It's a Substack that gives out a lot of good housing data. I don't have any of the specific markets in front of me, but I think the broad idea is that ever since the pandemic, there's been an accelerated move to the Sun Belt, which would be considered almost a strip from Arizona through the Southeast, like going along that line. And that caused not an insane amount, but maybe a huge amount of inventory to get built. Or there was just a ton of new construction going online in these markets from Arizona to Texas to Florida. And that happened because during the pandemic, when all these people moved there, rental prices and housing prices went up by like 20, 30% sometimes in a single year. And now we've seen in some of the markets like Austin, where rental prices and rental rates and housing prices have dipped kind of back maybe 10, 15% or something like that. So I do think there is that population increase, and it seems like it's continuing. And that's where a lot of the home builders are going to benefit because they're starting these new communities. They are, there's more people there. It's a very simple equation. There's more families getting started. There's going to be more houses that are going to be under demand, but we're not in the same, say, super optimal period where they had a giant tailwind a few years back. I'd say, again, like the whole market, it seems more normalized, and we'll see what happens over the next few years here.
Yeah, that's good. That's good context. It's funny because the PEs for these stocks are just still crazy low, even after their huge run ups. And it's like, I have to sometimes moderate to myself, like, okay, calm down, don't drink the Kool-Aid. Like, to Brett's point, like things could unravel at any point, but they still look attractive from a PE basis. And that can be very appealing sometimes.
Yeah, definitely the trailing valuations look attractive. It's not maybe like abnormally attractive relative to their own history, because home builders tend to, DR Horton versus Google, there's probably a little more trust that Google's going to grow earnings over the next 5 years pretty reliably because they're less susceptible to the macro environment. Whereas I think home builders just generally, there's constantly like housing cycle risk, especially from analysts. And that's kind of a big overhang and probably one of the big reasons it tends to trade at those sort of lower multiples. But I will say over the last decade, that's benefited a lot of the home builders. They've been able to buy back a lot of stock and grow earnings per share at a faster rate than they maybe otherwise would have.
Yeah, I think when we're looking at potential home builders to add to our portfolio, yeah, that PE makes sense, or even kind of normalizing some earnings, makes sense for doing any valuation work. But I think some of the keys we're looking for is a management team that understands it's a cyclical business, that's not getting too over their skis with their balance sheet and putting themselves in a risky position in case a recession happens or some downturn in the housing cycle happens, because we understand that their earnings would go down, but we don't want the whole business to blow up like a lot of home builders did in the Great Recession. So we'd want someone that definitely understands investing through the cycle, as you have to do in a cyclical industry. But also, as Ryan mentioned, an important thing is taking advantage of that low valuation with buybacks, because I don't think this is a sector that's going to see a lot of multiple expansion. And if your stock's trading at a earnings or free cash flow multiple of 8%, 10% for a long time, well, we would hope you would take advantage of that by buying back stock.
100%. Some of them do a lot. Are there any names that look attractive to you guys now or have looked attractive for a while?
I tend to lean more towards the asset light home builders. So to kind of break that up a little bit, I think NVR really sort of pioneered this model when they came out of bankruptcy, and a whole bunch of other industry peers have copied them. Some have chosen not to because they believe in their own abilities to kind of pick the right land and invest in the right places, stuff like that. But basically what this is it's just a land option model versus a raw land strategy. So the way this works is if you are going in NVR's case, let's say there's a big plot of land where they can build 20 homes or so. Typically, I think when people hear home builders, they probably think, okay, they buy up the whole chunk of land. They hold on to that land on their balance sheet while they go out and they buy the materials and they flatten it and they level it and they build the homes themselves. However, while that was at one point what the industry was like, it's changed a lot now because of this NVR model that they pioneered, but it's called this land option. So instead, what they do is they pay typically 5 to 7% of the land value up front, and then they can exercise the right to pay the remainder once the lot is finished. So they're still going out and they're getting the subcontractors and they're procuring the materials and they're trying to find buyers. But the land itself is typically being held by a land bank who typically you have to have some size as a home builder to find a land bank partner, or at least to find one where you're getting a nice rate. But what it does is it alleviates some of the risk associated with a downturn while that if that inventory were on your balance sheet and things went sour, not only would you struggle to find buyers, but then you'd be sitting on literally land not really earning anything, and you'd have to potentially mark that down or sell it to a buyer at a significantly lower price. you don't really have that risk. At the most, you have to forfeit that 5 to 7% deposit that you put down at the start, but it definitely saves you in rougher times. And we saw that with NVR and their ability to really be profitable through the great financial crisis. So a lot of companies have sort of leaned more towards that model. For me, DR Horton, which is actually the largest home builder in America by volume, just in terms of home deliveries, they're a business I like. And over the years, it's basically switched. At one point, it was 70, over the last decade, I say only a quarter of their land was owned by options, whereas the other one was, well, I shouldn't say owned, was maintained or held by options, whereas 75% of it was owned outright. It's now switched over. I think right now it's at about 75% is the land option model, which is just makes it more asset light, less risky in case things go bad. And they've been able to kind of reduce leverage in the process as well. So I like them. They are primarily entry level homes, so homes below $400,000. Obviously, being the largest home builder, they operate across a lot of states, but a lot of it, I think, around 50% of the home deliveries or home closings come from that Sunbelt region, which Brett was talking about. So I like them. And the other part that I'll mention here is the home builders, especially the larger home builders, develop economies of scale that smaller home builders can't compete with. So, for example, you're able to buy land cheaper and oftentimes better. So you can get bigger plots, you can get bigger discounts for buying more plots. And then you're probably more likely to have land bank partners that are willing to help you option the land. So that's one advantage is in the buying process. But you also get, and this is a big one, is you get better rates from subcontractors. So if you think about it from the subcontractor's perspective, let's say you're the guy that goes in, I don't know, installs the dishwashers for these houses. If you can go to a DR spot where they've got 40 different homes right next to each other, you bring your truck, you bring your team, you bring your materials, you bring it all to one spot, you can go location by location and do this. And it's much, much, much quicker than having to go to one home here, drive to another one somewhere else and do that. So you're likely going to offer a better rate to DR Horton in that case. And then the last one is just cheaper material. So there was actually an interview with one of the board members of DR Horton, and he talks about the business, and he says, DR Horton buys its appliances from Whirlpool. They are now buying 90,000 dishwashers a year. They used to buy 30 or 40,000. They're going to get a better price on a per dishwasher basis. So ultimately, being that large leads to better unit economics, which you can then redeploy into either more land options or repurchasing stock if it seems appropriate at the time. So they're one company that I kind of leaned into, and yeah, I'd say those are probably the biggest reasons. Brett, any that you keep track of?
Oh, I keep track of them. I mean, DR Horton, LGI Homes, I guess they just reported today, so they're top of mind. NVR, Dreamfinders Homes. There's quite a few out there, and sometimes it's hard to determine, like, all right, what makes these different? At the end of the day, sometimes they aren't that different, given the valuation, given how they all are affected by the macroeconomic cycle. But one thing that, and Ryan mentioned the switch to the land option model, which DR Horton did successfully. And the reason they want to do that is to get a better cash flow conversion. And they have improved that. But one of the things that keeps me a little bit hesitant with home builders is the fact that they generally do not convert all their earnings to cash flow, which is something I'm looking for as an investor. That's very important to me. If I look back to September of 2015 on any annualized period, DR Horton has never generated, like, its free cash flow conversion compared to its operating income has not even gotten close to 90% in any trailing 12-month period. And that's fine if you're reinvesting and you have, inventory on your balance sheet that's going to turn into earnings and, blah, blah, blah. We keep the cycle going. But it can hurt your ability to buy back stock. It can hurt your ability to get tied up in that inventory during a recession, but they're in a better spot because they have that land option model. So it's not foolproof. It's not like they're turning into they have no assets on the balance sheet. They still have a lot of assets, but it's a lot easier for them. And this is why they've improved their balance sheet and why they're in a much healthier position if a downturn occurs.
Yeah, and that's why also why they get the earnings valuation that they do most of the time. One of the reasons is if you look at the cash flow multiple, it's going to look substantially higher for pretty much every home builder unless they've turned off all investments for a year. So the cash flow multiple might look a little higher, but you really have to believe that the money that they're or the cash flow that they're bringing in and what they're redeploying into new land, they're going to be able to put people in those homes and do so at an attractive price where they earn money on those homes. And hopefully, I mean, that's resulted in pretty good returns on equity for a lot of the businesses. But like Brett said, just because it's land options doesn't mean it's completely riskless in terms of the balance sheet. They are putting money into those options. So they will, or I guess they're putting deposits down. So there is the chance that if there was a giant recession, no home buyers, they might have to forfeit those deposits, and it would certainly provide a rough year for them. But the good thing is hopefully not as catastrophic as outright owning the land.
That's all great stuff. I guess the big question then, you mentioned at the beginning, there's kind of some differences between the land options and the ones that are doing the buying of the land. So what would be some examples of companies that are just doing the opposite of that are just buying the land?
I can't remember them off the top of my head. I know there's some that...
Sorry, I didn't mean to trip you up.
No worries.
The Pulte Group, or I don't know how to-
Pulte would be one they've talked about, and I don't know what the exact numbers are, but whether it's like 70-30 or 75-25 is their long-term goal, but they're not there yet. They're more like a 50-50, and they're like a DR Horton where great financial crisis, it was a very low percentage of options. So I don't know. I can't think off the top of my head of any that are like 100% owned. But I mean, there's a lot of home builders too, so it's hard to just paint them all with a broad brush.
Right.
Yeah, and one thing that interests me is how much the landowners or the people that they're doing this land option deal with are going to put up with this over the long term, because I heard that NVR has to be very specific. And from what I read studying the company at one point, now it's been a little bit of a while since I've looked at them, but I think I remember seeing that it's not as easy as you think, because while it is a more advantageous deal for them, they have to be in a position where that landowner wants to make this deal. So you need that reputation, and no one, the people that own the land would rather sell it to you outright at first. So I'm interested to see if there is any sort of ceiling from the market itself, because I know everyone would want to do this. It's just the fact that, we'll see. We'll see what happens from like the data. If it keeps marching higher, that switch for all these companies.
Yeah, there are some reasons to own the land outright. Like if you believe you can buy a certain plot of land and you have the team to be able to level it and kind of produce it more economically than others. If you're really good at buying the land and the land appreciates, you're earning that little extra juice on it as well. However, it is, like Brett said, riskier strategy. So I think most companies would be inclined to do it. The other part is from the land bank. The land bank's perspective, cycle times are big here. So if you're a company like NVR or DR Horton, where you're able to produce the homes, and these at their core, they're basically manufacturing businesses. So if you're able to bring those cycle times down, it also reduces the risk for the land bank, where they're not going to hold it for maybe 3 or 4 years while you're building these homes. Hopefully it's significantly less, and you're able to reduce the amount of time that they're going to have to hold it on their balance sheet.
Yeah, and just for any listeners, these aren't individual homes that are designed uniquely. These are almost those ones that get turned into memes online, where it's like the robotic communities. The homes look very, very similar, and there are these cul-de-sacs and stuff like that, which is what Ryan is saying, how they're almost manufacturing businesses, because within these communities, a lot of the stuff is replicable.
It really is. Those are all great points. One thing that made a big impact for us personally, and maybe this changes if interest rates change, but when you mentioned the incentives that builders can give to home buyers, they were able to give us a rate buy down. So it's like, we can get a new home instead of a used home. And oh, by the way, our mortgage is cheaper than buying from existing home. So I won't speak for DR Horton because I don't know if they have a similar thing, but I know for Pulte Group, they have their own in-house financing We didn't buy with Pulte, but just as an example, they have an in-house financing. And I can see that as being a potential competitive advantage for a home builder if they can offer that to people, because it's like, sure, I'd love to have a lower mortgage.
Yeah, it does affect their margins because they're, kind of taking that cost off of you a bit, but it's better to get you in the home and have a slightly lower margin than to be sitting on that unpurchased plot or that unpurchased home forever. Typically it's happening a lot right now. DR Horton has talked about how they're doing this. They're planning to raise the incentives right now because demand has kind of gotten a little tighter. The people have seen rates come down a little bit, and they've said that a lot of the prospective buyers are saying, well, I think rates might come down a little more next year now that they've already come down. And it's one of those tools where it's like they don't want to offer these mortgage rate buy downs because it's obviously it hurts their gross margins a little bit. But if they can get you in that home a little quicker, they're still generating a good return on the money they deployed.
Yeah, it connects back to the concerns around the dynamics between existing versus new home sales, because what counterintuitively higher mortgage rates have helped the home builders because new homes have seen a boost in demand versus existing. And we've also seen during this time period, I think that the new builds have started to slow down, but over the last 3 years, there was a huge increase in multifamily, which is essentially apartment buildings or duplexes or stuff like that. That's why it's called multifamily. That has essentially demand that would have gone to existing home sales has switched to new homes and rentals. And if mortgage rates come down, I'm not necessarily sure that helps the home builders. It might hurt them because then we could see demand shift back from new home sales to existing ones. So that's something to watch out for. And when people say, well, lower mortgage rates are going to be good for the housing market, that might be true, but it doesn't necessarily mean the home builders are going to see increased demand. It just might mean we see an unlock of inventory from the existing homes that are out there.
So it would be incrementally lower demand from whatever they have now if you just get supply.
Now that's the logic I go through. But when looking at these things, there's the geographical variables. There's all these other variables that can come into play. So sometimes might not be how it plays out exactly, but I think all else equal, that's what could affect these home builders. I think we saw last quarter where backlogs have come down and they're pushing those when they're doing that mortgage rate buy down, they're saying that the only way the affordability is so tough, and they're going to the new home sales, but the affordability is so much worse on existing home sales. So if that ever normalizes, I think it's really hard to argue it won't impact new home demand.
Yeah, it makes sense. How do you guys feel about like the temperature of the valuations of the home builders? Fairly valued, undervalued, slightly overvalued, bubble? What you got?
I'd say fairly valued.
Yeah, I think that's probably accurate. I mean, I own some of them, so I'd like to say that they're, super cheap, but it's one of those where it looks cheap on a trailing basis, and it always feels like the next 12 months are kind of up in the air. In the time that I've been looking at the real estate or following any sort of home builders, there's always the risk that existing home sales kind of skyrockets. Something happens with rates that really prevents buyer demand, and all of a sudden that trailing earnings multiple is not really indicative of their future earnings. But 3 years ago, people were talking about like this real estate apocalypse, essentially, with rates going to 8%. What's going to happen? And you saw the home builders weather that really well. And as Brett talked about, it actually ended up being a little bit of a tailwind for them. So
I would say a major tailwind, but maybe that's me. I'm a little more bearish on it.
It was a major tailwind, especially because people didn't want to get out of their existing homes, but it still impacted affordability in a huge way. So there are certain people that just could no longer be buyers. The amount of potential home buyers probably shrank. I think I call it a fair valuation because to me, it feels like there's not this huge supply. There isn't this or I guess the shortage might be a little overblown, because you could have what Brett talked about, where if rates come down, people finally feel free to enter into a new mortgage and move somewhere else, because the last thing you want to do is you've got this 30-year 3% mortgage, and all of a sudden you're thinking, oh, I'll sell my home and I'll enter into a 6% mortgage or whatever. So as rates come down, maybe that unlocks a little bit of supply. The shortage doesn't seem quite as bad. It just seems to me that there's really actually a reasonable sort of equilibrium. Like, it's at a good spot now in terms of demand and supply. I could be wrong, but it feels that way to me. And if you're paying sort of 10 to 15 times earnings for some of these businesses that have grown earnings per share double digits, I know DR Horton and NVR have produced 20 to 30%. NVR is actually even higher returns on equity. If they're able to continue redeploying, it might be a rough next 12 months, but it's kind of, those economies of scale are going to help them grow share over the years. And I know it sounds kind of dystopian, I guess, to see like every house in the future is going to be these manufactured communities and you're going to live in the home that looks the exact same as your neighbor. But if they're bringing down, or if they're making homes more affordable for people, and they're putting new supply online and they're able to produce it more economically than other ones, they're still going to benefit in the long run. There's always the luxury home builders if you want to customize your own and pay more for it. But I don't think having a lot more affordable homes come online is a bad thing, generally speaking.
The supply will match up with where the demand is, because as Ryan mentioned, the 3%, people that are stuck with the 3% mortgage rates, they're not going to immediately go to the 6%. But we're seeing some of the home builders increase their single family build to rent. So building a single family house, which historically has been atypical, we're seeing a much larger percentage of that happening, which I think is just, following where the market is. If mortgage rates are going to stay high for a long time, we're probably going to see more than that. That's how the market's going to equalize. And then speaking of the stock chart, like, these stocks can be volatile. Like Ryan mentioned, there is uncertainty. Like, who knows what's going to happen next quarter? Who knows what's going to happen in the next few quarters? If you look at DR Horton over the last few years, we started at around, this is the last 5 years, started around $50, COVID bust, down to 30, then up to 100, then down to 70, then up to 130, then down again. And then we end at close to 200 today, August. So they have dipped after the recent earnings report down to about 173. And the stock's up 238% over the last 5 years, excluding dividends. So the next 5 years are probably not going to be 250% returns, but even if there is volatility, these are well-run businesses. And again, we talked about how important it is, the balance sheet health and the management returning capital to shareholders. That can help you generate value through the market cycle. Or just what attracts Ryan to the industry, and I don't know any of these stocks, but they do sit on my watch list, is the fact that it's a lot different than the great financial crisis, where these balance sheets were really, really risky and we saw a lot of them file for bankruptcy. So having a blow up and a terminal value of 0 feels a lot less risky this time, given that they're not laden with debt and they have the assets. The balance sheet is, as we've said, I think I've said 3 times now, they're not way over their skis on here and are going to take a tumble.
Yeah, I'm with you guys on that. I feel like, to me, it seems fairly valued as well. I just like how home prices rise like the economy does. That's a pretty nice, easy organic tailwind. Maybe Visa has like a similar organic tailwind, and maybe Alphabet, but not a lot of businesses are like, oh, we opened and we're able to raise prices like alongside the economy. That's really nice to have.
And we're seeing a lot of incomes rising as compared to, say, maybe the post-Great Financial Crisis period. We're seeing a ton of stuff where unions or any sort of workforce are getting big wage increases over multi-year periods, and that could probably help demand with match some of that on affordability. Where I think we just saw today the Boeing strike ended, and they're getting close to a 40% raise over 4 years. And at the end of this 4 years, the average machinist there is going to be making $120,000 a year. So that will be much. And think about any home builder in the Pacific Northwest, they're going to have a much easier time fulfilling demand if that's the case.
That's a great point. Yeah.
There's also some flexibility for a lot of the bigger builders to like DR Horton talked about this on their latest call, where if they're getting worried about affordability, or maybe their sort of buyer list is becoming shorter than usual, they can reorganize the footprint of some of these communities to do smaller formats where they reduce the average selling price, but because it's still quite efficient, to maybe they were going to build 20 homes in that lot. Now they build 30 homes, lower selling price. People, all of a sudden, it becomes a little more affordable for them, but they're still able to generate pretty good returns on those lots because of those economies of scale that we talked about, where there is kind of this assembly line manufacturing process.
What are some of the risks involved in investing in some of these companies?
Ones that have a lot of debt. I think there's one that's popular called, I haven't looked at them recently, but Dream Finders Homes. I think they take out a lot of debt, even though they have the land option model, and that can catch up with you in a down cycle. I also think, just in general, the housing cycle can catch up with you. We mentioned that over maybe a 5 to 10 year period, you can get healthy returns if you have a well-run home builder at a reasonable valuation on normalized earnings. But Ryan, would you be surprised if DR Horton was down 50% in 18 months from now if the economy, went into a tailspin? No, I mean, they're going to be hit, and investors will probably hate it, but the stock might be a great buy there. So maybe I'm too greedy, but I always tell myself I'm going to buy these when the economy's in the tank. On the other hand, though, psychologically, that can be a lot harder, where it sounds nice now, but when you get there, the numbers might look bad and you might convince yourself not to buy.
Yeah, the 50% drawdown sounds extreme, but it's happened before. And I think a big reason for that is, especially with the housing market, people love to extrapolate short-term data outward. So like, okay, DR Horton talking about how home buyer demand has dipped a little bit with the recent rate drop. Instantly, people saw that on the call, and the stock dropped, I think, 15% initially the next day. And it's people thinking, this is the beginning of something. This is the beginning of kind of the drop in demand. But I think a 50% drop is possible. I would say the biggest risk is, depending on the home builder, it's really kind of balance sheet risk, because it's really easy in good times to say, oh, they're getting good, that they're closing on most of the homes they build. It's they're finding lots of buyers. The cycle times are great.
You got a big backlog.
Right. And you've got all these buyers that can cancel, right? The cancellation rates could go up. So you've got this, like, it's easy to kind of push the leverage in those times. I think with DR Horton, and I guess I haven't looked closely enough at some of the balance sheets of the other big ones, but bringing down those leverage ratios and having a pretty cash-rich balance sheet, along with that land option model where they're hopefully, even in a rough downturn, still profitable, it gives me kind of a little bit of comfort in knowing that if the stock did drop by 50%, they have a share buyback program in place, and they've shown their ability to use it. And it's not like they're going to have to focus exclusively on paying down this debt. It's very manageable. So the big risk for me would be those that are sort of over levered, and especially if you combine the leverage with owning land outright model, that can work really well in good times. But as we've seen with the GFC, it can be sort of catastrophic in the bad times.
I mean, this is kind of a joke, but anyone watched the show Arrested Development, the whole first season, right? They just watch that show if you want to look at a badly run home builder in a kind of a parody mindset. Obviously, that other stuff's a bit extreme, but that's what happens. They're sitting on the land. They built a model home, and they can't sell the land because they're going to take a giant loss on it, and that would ruin their balance sheet.
That's awesome. So I guess my last question would be, what kinds of things, like, are there any KPIs or things that you should look for when you're looking at home builders to, I guess, separate the good from the bad?
Yeah, I would say cancellation rate is one. Not necessarily to separate the good from the bad, but the just in terms of, like, if you're if you own one of the home builders, it's definitely a KPI to track. I will give kind of a shout out to FinChat here, where they actually track those for you, so it makes it real easy. Cancellation rates on there. I know plots owned by options versus plots owned by raw land. So if you're comparing home builders to home builders, that's another KPI to track. That's pretty important, assuming that the home builder breaks it out. And then I guess home deliveries over time gives you a sense of home deliveries and return on equity. If they're increasing the amount of homes they deliver each year, and they're doing so at a pretty good return on equity, it's usually a good sign that they have something in their system, something in their business model that's unique and hard to replicate.
Yeah, if you didn't mention inventory turns, I don't know if it however they calculate it compared to a retailer, but that matters a lot, especially for the cash flow conversion. I'll talk about maybe one important thing from a macroeconomic perspective, because it can matter here. And the good thing is there is a lot of great data out there that people compile on the housing market. And the one thing that, and again, I'm going back to just stealing stuff from the Calculated Risk newsletter, it is inventory. It could be combination of everything: completed homes that are in inventory, under construction inventory, stuff that's not started, so like land that's going to get built on. Could be the amount of months of supply. That matters the most, because historically it's helped really predict how aggressive or bullish or bearish you should be on the housing market. And we've seen over the last since the great financial crisis, inventory for new homes increase. Now it seems like we're getting more to a normalized period, and that's why I say, again, making any sort of macro prediction isn't usually the smartest, but it seems like we're in a normalized environment as opposed to post-great financial crisis, where it was an optimal environment for the home builders that survived. And tracking this can be helpful, because if you look at a home builder and you say, well, the PE's down at 4 and I don't know what's going on. Well, maybe some of the analysts out there on Wall Street and stuff like that are seeing that inventory is growing, and some of those forward-looking KPIs, specifically for the companies that Ryan mentioned, are worsening. And it's not necessarily all about a trailing PE, where at these stocks, it's about normalized earnings. It's about how much they can earn over a 10-year period, but it's going to be lumpy along the way.
I really think you're onto something on that as a leading indicator. There's a book called Capital Returns, and he talks about when you're looking at commodity. I mean, a house is not commodity. People love their homes, but it's kind of like a commodity in a way when you're home shopping. He says that when you're looking at something like that, you can try to forecast demand, but it's so hard. But you can measure supply, and that can often be a better way to get a grip on the situation. So to your point, those supply numbers, inventory numbers can really, really help there.
It's a fascinating space because people are often kind of sit on both sides of it, and there's always takes on the economy overall that affect it, and kind of people's views on interest rates. So I think ultimately what we've seen over the last decade is that some of these businesses, even if there are big changes in interest rates, they have real durable advantages that, if they have a bad year or two, can still allow them to take market share. And I think, judging by the fact that this industry's been around for probably 250 years, I don't see that. I think there's some durability in the industry itself. So having those big advantages should help the companies that are leading right now.
And just wait till they have the Optimus bot building it, right? then
That's
it'll
the
be
disruptor.
Yeah, that's the next. Yeah, exactly. I remember, I bet during the 3D printer bubble, they probably were thinking about, well, we'll just wait till we 3D print the homes. But as Ryan mentioned, 250 years, I don't think much is going to change over the next 10 to 20 as well.
Something I like about your guys' content in your show, fellow moat investigators, you guys tend to really think deeply about those things.
It's a investment research service, and they covered Evolution AB, which is formerly Evolution Gaming. It's a back-end provider for digital casino games. So think, you got a big casino, they want to do online casino games, and they're the back-end provider. And you might think that's a commodity product, but there are a lot of nuances to this business that give it, from as Speedwell gave as a great pitch, potential competitive advantages that could grow over the next 5 to 10 years. And the stock's trading at what could be, obviously no promises, do your own research, listen to that episode if you want, could be at a cheap earnings multiple. So if anyone wants to check out the show, I'd recommend starting with that episode. It should be one of the recent ones. Maybe you'll find it right near the top of the feed.
Yeah, one more I'd call out, and this one is a little older, but still very relevant and not at all related to the home building industry. But Brett gave a pretty good deep dive into the stock Remitly, which is a remittance provider, kind of really popular in the US, and they've been growing pretty quickly. So that's there as well. The title is Why I Am Buying This Hidden FinTech Stock. So I guess spoiler alert, I gave the title away there, but it's a good deep dive.
I think, we did that for the first day, and then we tossed in the ticker. Got to have the SEO stuff cooking up there as best as possible. But yeah, that one, hey, usually, the timing on stuff doesn't work out, but that one somehow, bought it at a good time. They had some good earnings last week. So that was a fun one to look at, and I think it's a promising growth stock.
Agree. So where else besides the podcast, where else do you guys hang out? Where else can people find more about you?
So if you want any Chit Chat stock stuff, there's a Twitter account. We'll post the shows, any updates about the shows. We also have our personal accounts that you can check out, and you can find the podcast, YouTube, Spotify, Apple Podcast, or our Substack newsletter, which is generally have some thoughts on there, but a lot of it is going to be show notes and charts around episodes. So we have it as a lot of the times it's a free one, but a supplementary tool, because when you talk about data, sometimes it's hard to visualize it. It can help to have the charts there. So whatever places people are, whatever platforms people like, subscribe and follow it. Check out any of our work.
Yeah, please do. It's well worth your time. I've been following these guys for a while now, and I learn something new from them every day, whether it's their personal accounts or whether it's Chit Chat Stocks. The podcast it's superior. It's great stuff. And as you can see, they do a great job of explaining things in detail and in clear, concise ways that even dum-dums like me can understand. So it's a lot of fun and it's enjoyable too. So guys, thank you very much for joining us today. This was a lot of fun. I know I learned a lot, and I know our listeners will learn a lot about this important sector as well. So thank you very much for joining us. And with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.